go ahead and find that. And for those of you, again, who have just now joined us, you can send in your questions on this AMA, Ask Me Anything around large apartment syndication, 100 units or more. You can send those questions to dan@passiveinvesting.com. And as those questions come in, I will be looking at these questions and try to answer as many of them as possible. I know at the webinar like this, a lot of times it's hard to get through all of the questions that come in, but even if I don't respond to your question on the webinar live, I'll either respond to it privately, or I will also maybe do a future webinar where I answer some additional questions. So one of the things that I'm doing right now is I'm in the process of writing a book on this topic of apartment syndication. And this book is going to be different than most other books that you might have seen or read around apartment syndication. It's going to be geared primarily to teaching you how to create and develop a business, a true business around apartment syndication, but to develop that business around your life so that you can be able to still have a business, that you're still being able to use it as more of a passive type business. And so I'm going to teach you in that book what we're doing at passiveinvesting.com, but also how you could potentially do that as well. It's not easy. It's a lot of work. Anybody who tells you that apartment syndication is easy is lying to you, because it is not easy. There's a lot of work that comes involved with apartment syndication, a lot of moving pieces and a lot of moving parts. Actually, today, as we're recording this, you might see me jumping over here to my email to obviously check to see if we have questions coming in. But we are also in the process today of closing a large multifamily deal today. So this is October 22nd, 2019. So I'm dating the video a little bit. For those of you who might be watching the recording later, but today we are actually closing one of our largest deals. It's a $51.5 million project, and today we are closing that project, and we were able to do that in 49 days from the time the contract was signed. So us raising the money, doing the due diligence, all the legal stuff, getting it all closed up in 49 days, and we originally planned to do it in 51. So we'll have a future webinar where we go over some of the specifics about how we actually were able to do that and perform on that particular acquisition. So for those of you who are on here who have some questions, go ahead and type them in. And also for those of you who just joined us, you can send over your questions to dan@passiveinvesting.com. And then you can also send on the chat box, type in there where you actually are tuning in from. So we have James here. We have Bobby from New York. Good to see you, Bobby, there. Good to have you on these webinars. Scott as well from New York City. We have Lugie from Canada there. Winston from Atlanta, Georgia. Megan from Kentucky. And we have James from Colorado. And let's see here. We have Devin from Harrisburg, and then Ryan from Asheville. And let's see here. All right. Great. Awesome. So let's do this. So for those of you who have some questions, type them into the email box there. Just shoot them over to my email real quick, dan@passiveinvesting.com, and I will answer those questions here live on the webinar. I do have a couple of them that came in yesterday from people who had already registered for the webinar. And so I'm going to go through some of those questions to see, to kind of get us started, and then we can kind of go from there. So let me pull up this email. All right. This one is from James. And one of the questions he says is, I'm just going to read this question. Which comes first, the market analysis to find a good place to invest, or analyzing a good deal? In other words, if someone in your network presented you a property to buy, would you sign it under contract first, then perform the necessary market analysis during the due diligence period, while also running your analysis on the property? So there's a couple of questions here. And then the follow-up to this was, or do you first pick a locality to invest in and then consider deals in that area? A little bit confused on how to start. So that's a great question, James. And one of the things that I would highly recommend you do is always do your market analysis and research up front. And the reason why is because in these larger apartment spaces where you are dealing with larger institutional investors that you're competing with and various things like that, going 100 units or more, then what you're going to want to do is be ready to make that offer. And also, a lot of times, in order to compete in the current market today, putting up hard money, basically that earnest money deposit that goes hard day one, is rather important and fairly crucial. And so you want to make sure that whenever you put in a contract on something, that you're confident with that particular deal, because you might be putting up $100,000, $200,000, or even on some of our deals, we put over $1 million in as a hard money on the first day. So that we actually put the deal under contract. So you want to make sure that you have your ducks in a row beforehand. So making sure that you actually go into it with the market analysis already done is very important. Now, that doesn't mean that you're not going to continue to do market analysis. So when we get a project or get a particular deal, we already know generally the market and some of the sub-markets that we like in a market and where we're going to be looking for deals. When a deal comes through our desk, we're going to look at that deal a little bit closer. And usually there's a couple of weeks on some of these deals that you can really look at to really understand the market or the sub-market that it is within a market that you might actually be wanting to go after. And so whenever you go into that particular deal or you're looking at that deal, you're going to look into that submarket a little bit closer, all the way down to as hyper local as you can. For example, tomorrow I'm actually driving up to Raleigh, North Carolina, and myself and one of our other managing partners, Brandon Abbott, will be touring another property in Raleigh, North Carolina that we are looking to acquire. And while we are there, we are also going to shop the comp properties, the competitor properties that are around the property that we want to acquire. And we know Raleigh, we know that submarket, but we also want to be as hyper local to that particular asset as possible. So we use other resources to our benefit, like CoStar and various things like that, and Google Maps, and just research on apartments.com. But we also go and actually put boots on the ground and actually tour the property, no matter what the deal is or where it's located. Unless it's like across the street from where we are, or maybe we're buying one of our competitor properties, obviously we're going to have a lot more knowledge, deeper knowledge about that particular market. So to answer your question, yes, pick the locality or the market that you want to invest in first and know it like the back of your hand, and then start to have those start to look at the deal flow and start underwriting those deals. At the same time, it's hard for me not to be able to stress this at this point, is you want to also make sure that you're always looking for investors, because in the syndication space, you have to have that prior existing relationship with your investors. So you want to make sure that at the same time as finding the next deal and doing market analysis, that you're also looking for investors for your next project as well. All right, let's see here if I have any other questions coming in here. All right. I do have a couple of questions from James. I'm going to try to jump around here and see if I have any other questions. Let's see. All right. So it looks like we have a question from Milton about, I've been approved for a $1 million line of credit to cover the purchase and rehab cost of up to a 20-unit property. I desire to do larger deals, 100 plus units. Should I buy multiple small multifamily units I can qualify for myself, or take my capital and put it towards a syndication deal? Which is better for my long-term goal of being a syndicator, and why? So I would suggest that if you have not syndicated a deal yet, using some of that capital, Milton, to invest in other syndicators' deals first, and maybe even jumping alongside them as maybe a co-GP or co-sponsor, and helping them with various aspects that they might need help with, whether it be underwriting or due diligence or boots on the ground comp analysis or market analysis, doing some of the unit walks, and also, helping to bring some of the equity to the table as well, or maybe putting up some of the risk money. Maybe somebody wants to needs $200,000 or $300,000 of earnest money deposit that they need for a project, and you can come alongside them and help with that. Or maybe you have some net worth or liquidity that you can help with on a project. So you have to really ask yourself where you have the most benefit for another group or another operator to see where you could be the most benefit. I would suggest, if it was me, again, I'm not going to give you financial advice or anything like that, because I'm not a CPA or a financial advisor or anything like that. This is just purely my opinion. If I was in your situation, what I would do is I would take the capital and not buy smaller multifamilies, but go straight into the larger multifamily properties. And if you can't do them by yourself, which in certain, and then you might be able to do some of the smaller, larger ones, like maybe 120 unit one by yourself, it's still a good idea to even syndicate those to be able to diversify your own investments. But And so you can acquire lots of different properties with the capital that you have. And so that's one of the reasons why it's important to be networking and going to events and various things like that. Speaking of events, last week we did a webinar on the conferences that are coming up. And if you go on our YouTube channel and search for the multifamily conferences, I included a spreadsheet on there, a link to a Google spreadsheet that I'm going to be keeping updated on the future multifamily conferences and special links and discounts that you can get for registering for that as an MFIN member. And so obviously it's free to be an MFIN member. We have almost 15,000 now that are part of the community, but that spreadsheet will be constantly updated so you can continue to do that and see which events are coming up. I will plug my event coming up in January 2020. It is the Multifamily Investor Nation Summit. You can go to mfinsummit.com for details on that. And I am going to be giving away a ticket to the next Multifamily Investor Nation Summit. And what I want you to do is I want you to subscribe and listen to one of our podcasts, which is just Multifamily Investor Nation on iTunes or another platform. You can submit a review, take a screenshot of that review, and just email it to me. Email it to dan@passiveinvesting.com. And I will be doing a drawing next week for those of you who actually post a review. I'll be doing it next week on the webinar we're going to be doing next week. So make sure you stay tuned for that. All you have to do to register for the webinar, obviously you guys know how to register for the webinar, but the only thing you have to do to subscribe to the podcast is I'm going to put a link in here, mfinpodcast.com. It'll hot link you over there to iTunes, allow you to subscribe it, listen to one of the podcasts, and then review the podcast for us. We're trying to get to 100 reviews, and so that's one of the reasons why I wanted to do this. But do that today, and you might even get a ticket for the next Multifamily Investor Nation conference. So for those of you who have joined us a little bit late, make sure you email your questions to dan@passiveinvesting.com, and I will be going through some of these questions as they come through. Let's see. All right, so one of the questions that I have from Marina is, for heavy value add projects, sometimes there is a construction management fee. What have you seen this to be? Is it a percentage of the construction cost or purchase price? And what percentage of the construction cost or purchase price? So typically the construction management fee is a construction management fee that is usually paid to the property management company, who is the one who will likely run the construction side of things. But it can also be the actual sponsorship team that is running the construction. And so that usually ranges on the low end around 5% up to about 10%. And that depends on the size of the deal as well as the size of the project or the renovations. And that percentage is typically based off of the construction costs. So it's not a percentage of the overall deal. It's only off of the amount of money that's being spent on the construction side. It's a good question there. Another question here. Sometimes banks require reserve from the syndicator to provide liquidity. What have you seen this to be? Is it usually a percentage of the loan amount or mortgage amount or the purchase price, and what percentage? So this is going to be going more on lines of either the loan requirements or the lender requirements for the sponsorship team. And there's usually three things that they're looking for. Number one is net worth of the loan balance. So whatever the loan balance is, your team as a whole needs to have an aggregate amount of net worth that meets the loan balance itself. And then the other rule of thumb is 10% of the loan balance is what you're going to need in liquidity. And so you kind of have to think about that ahead of time and plan for that as you're making offers on properties and looking to acquire. Is, do you have enough net worth and liquidity inside your own team? And those are typical requirements for these non-recourse loans, Fannie Mae, Freddie Mac, as well as some local lenders that do some non-recourse. There's also bridge lenders that have that requirement as well. Sometimes with the bridge lenders, you can negotiate a little bit lower on the net worth and liquidity, but it really just depends on which bridge lender that you're working with in regards to whether or not you can negotiate lower amounts. But that liquidity requirement is based off of the loan amount. So 10% of the loan amount, the loan balance, and then the net worth requirement is based on that. The third thing that they're looking for is experience. So you want to make sure that you have someone on your team that has experience managing and running these types of properties. And that's one of the reasons why earlier on, when Milton asked the question about what they should do with that money, I would suggest joining another group to get that experience, because you still have to check that box of having experience and being able to run these types of assets. So you're going to probably give up some equity to do that, but it's also part of the learning process and starting to build your syndication business that way as well. Let's see if we have any other questions. Recently saw an article about it is illegal to pay people for raising funds if they are not part of the team unless they are security brokers. Is it legal to pay referral fees to non-brokers? So it depends. The question is about referral fees. And so yes, well, first off, it is illegal to pay somebody who is not part of your team to raise money for your deal unless they are a broker deal and have that securities license. The part about the referral fees is that you are able to pay referral fees to anybody who sends somebody to you, but those referral fees cannot be based on the amount that's being raised. So to give you an example, in our group, we actually allow our investors to send their family and friends to invest with us so we can start to build relationships with them before our next deal. And if that particular person decides to invest in our next project, then no matter what they invest in, whether it be $100,000 or $200,000 or even $500,000, they're going to get a one-time $1,000 referral fee. And that is perfectly legal. You could talk to any SEC attorney and they'll let you know that you can give referral fees to your potential or to your investors or to anybody for making referrals. It just can't be based on and tiered based on the amount of money that particular person is actually sending you. And it typically needs to be a one-time fee. So good question, Marina. We are actually doing that ourselves with our group as well. All right, so we have several people still on here. Several of you are on phone calls, so it might be hard to, ask a lot of questions. I want you to see if you can email any more of your questions to dan@passiveinvesting.com. Looks like we have a few people that have been a little rebellious, and they've put their questions here inside of the chat box. Let me see if I can go through the chat box here and see if I have a few questions that have come up through here. All right, so Sid is asking, how do you acquire multifamily units and get good property managers to manage them if they're in the 10 to 20 unit range? I would like it to be as passive as possible. So the answer to your question, Sid, is that it is very difficult and it is very challenging. And I've tried it and we're doing it. You have to stay on top of those managers a little bit more, but at the end of the day, that's one of the reasons why I prefer to be in the large apartment space where we're 100 units, 200 units or more. And it's because of that problem right there, is that it's hard sometimes. You basically have to sometimes, because you don't have on-site management, you're gonna have to work with a typical residential or single family rental provider that just so happens to be able to take on these smaller multifamily properties. So it is a little bit more challenging. You're gonna have a lot more non-passivity, non-passiveness to that particular type of an asset. So again, that's one of the reasons why we prefer to do the larger 100 to 200 units or more space. So not sure if that was the best answer, or I know it was the best answer, but I don't know if it was the answer you were looking for, but hopefully that helps you there. So my suggestion would be to go to passiveinvesting.com and put your information in, and let's jump on a call and see if maybe investing in some of our assets, which will be very, very passive for you, and providing you some really nice returns would be great too. So anyway, all right, it's got a nice comment here from Christopher. Says, spoke with Nathan Tabor yesterday and he had the best things to say about you. Christopher Huffman from Salt Lake City. I'm going to be going to the Salt Lake City area in about 2 weeks, I believe. So yes, going to be going to Deer Valley, Utah, that area. So have a business mastermind conference and I'm going out there. Not real estate related, but it's a business conference. All right, let's see. All right, Winston is asking, what's your LOI, the letter of intent, to PSA, the purchase and sale agreement time frame? So this is going to vary depending on the seller and what kind of terms you can negotiate. We typically start off with a 14 business day turnaround on, it's going to be a 14 day, not business, but calendar day turnaround on that LOI to PSA phase. And so even on this most recent acquisition that we did, we had 14 days in there, but the seller was really pushing us and pushing us and pushing us to get it done sooner. So we actually locked up the LOI, went from LOI to PSA within a matter of 4 days. And so it really just depends on the seller and how much they're pushing you, because but this particular seller didn't even want to sign our LOI. They basically said, we see your LOI, we understand it, but we're not going to sign it, but you have the deal. And so it was actually imperative upon us to try to speed that process up of getting that PSA signed as quickly as possible, so that they didn't give that deal to somebody else if we were starting to drag our feet. And so typical time frame is probably between 5 to 7 business days to get that LOI into the point of having a PSA. So it just depends on the seller and how fast you move. Let's see a question here. All right, James has a follow-up question. In regards to the earnest money, can't you negotiate for it to not go hard until later on, or will that not work when dealing with commercial sellers? So you can negotiate that, but the problem right now with these larger apartments is that you might be able to say, hey, well, I only want to do, 100,000, and it goes hard after, say, 20 days or 30 days of due diligence. The problem with that is the guy behind you might be at the same offer price, but he is more confident with the deal. And he says, I'm going to put up 100,000. So same deal, same offer, but I'm going to allow it to go hard. I'm going to allow it to go hard day one. Or maybe he says, I'm going to put 50,000 hard day one, and then the other 50,000 after 30 days due diligence. And the seller's perspective, and that's what you have to always do. That's what I like to do, is I put myself in the seller's position, the seller's seat. I'm selling this asset and I have these various buyers. Who would I want to award it to, and how can I stand out as the buyer to that seller? And so you don't necessarily have to, depending on the deal and the dynamics of it. That's why it's very important to have a good relationship with your brokers, because those brokers will communicate to you as to whether or not you really need to put that hard money in there, and whether it needs to go hard day one or whether it can go hard after the due diligence period. So good follow-up question there, James. Ryan has another question, or not another, but Ryan has a question. Let's see. What is the highest value activity you do to make your business or team successful, and how often do you do it, and what is your schedule for it? Man, that's a loaded question, Ryan. I would say one of the things that we do, which we do on a fairly regular basis, I would probably say at least once a week, we're getting together as a group. Every day our team is communicating and talking, because we're all remote, but we're all 3 managing partners full-time in the business. So I think that's one of the things that makes us successful. But we're all looking at the various roles and responsibilities that we have and seeing where can we improve ourselves, but where can we also delegate some of these tasks to some other team members. And so we don't need to necessarily live off of the asset management fees that we're making off of our properties. And so what we've decided to do as a team is to use those asset management fees to grow and build our team. And so in the book that I'm writing, I'm actually going to be talking about how to structure this and how to set this up so that you can start to use those asset management fees to build out your team, hiring an asset manager full-time, hiring a full-time analyst, hiring somebody on the acquisition side, hiring somebody to actually perform the closing, whether it be you're acquiring an asset or you're selling an asset. So there's a lot of different roles and responsibilities that you're going to have in this apartment syndication space, and always being able to look at what you're doing and where you can improve things is very important. And then also having various KPIs and metrics, those key performance indicators in place to make sure that you are hitting the goals and the targets that you're looking for, and knowing when to pivot whenever it's necessary to pivot. All right, next question here. All right, so I have one more question coming in. If there's any other questions, you can feel free to type them in. Looks like I might have one. Nope, I already have that one gone through there. So if you have any further questions, you can feel free to submit them to dan@passiveinvesting.com. I told you this would be a fairly short one, about 30 to 45 minutes. We're coming right up on that 30-minute mark. And so don't forget to to subscribe to our podcast, MFINpodcast.com, and rate the podcast, review it. And then next week on the webinar, make sure you are attending that as well, because we're going to be giving away and drawing for the giveaway for the Multifamily Investor Nation Summit ticket that's coming up. And you can find some details on that by going to MFINsummit.com. All right, the next question here is from Winston. Do you add extension days to due diligence? And if so, how many? So typically on the due diligence, we are typically on a typical deal, we're doing a 30-30-30. And so there's different ways to structure it when you're negotiating. You can do 30-30-30 or a 30-30-14-14, or we've seen it sometimes 30-30-10-10. So that means 30 days due diligence, 30 days to close, and then you have the option to buy an extension for an additional 30 days, 10 days, 14 days, whatever you negotiate there. And so typically on the due diligence, we're not putting an extension there from the due diligence side of things. We are putting some outs in there that if during the due diligence period something comes up, we can actually back out. And obviously, once you get down the road, if you find something, you can try to renegotiate that with the seller. One of the things that we've had to do recently on one of our most recent acquisitions in a different market than Raleigh, in the Greenville, South Carolina market, is we had a deal that had some environmental things show up that didn't come up until about 2 weeks before closing, and it caused us to have to delay and extend. And we had to go back to the seller and negotiate that with the seller, because we had the option for an extension. We exercised that and had to go past that. And so we had to put some more money that was non-refundable up to be able to make that extension. But we knew kind of the parameters around the environmentals, and the owner or the seller at that time knew what they were going to have to do on a new buyer if a new buyer came along as well. And we were already very far along the process. And so most sellers, I would say, in the large apartment space, want to protect their reputation. And so they're not just going to pull the rug out from underneath you. If the story makes sense, and then that'll make sense as well. But it's also very easy to ruin your own reputation if you try to renegotiate these terms all the time. So one of the things that allows our group to stand out to sellers, and also for the brokers to be able to sell us and our team to the sellers, is that we do what we say we're going to do. So on this most recent deal in Raleigh, North Carolina, we had a 21-30 with no option to extend. So we had 21 days due diligence and then 30 days to close. And originally we had tried to do a 21-21 with two options, or with a 30-day extension option for extending. And they renegotiated with us, and we did a 21-30. Very tight timeline, but we knew our team that was behind us, and we could actually do that. And so we were able to perform there. And that's the deal we had. After due diligence, we had first we had to put $600,000 hard day one, another $700,000 due after due diligence, and so we had $1.3 million hard on that one, and we were able to get that one closed up today. I'm hoping we're going to get an email here in a minute telling me that we're closed, but I just got another email come through, but wrong figures on it, I think. But anyway, so. I'm not sure where I was going with that, because that closing email messed up with my head a little bit. But we were able to get that one closed. We're going to actually plan to close today. So we should be getting an email here shortly, and that'll allow us to close in 49 days. We actually did it 2 days early, and that looks really good to the seller. And it also looks really good to the brokers. I can't tell you how many off-market deals we're starting to get, because these brokers communicate with each other, and they're now talking about how we've been able to do this. And we're also going to have a press release that's going to go out as well. That's going to, announce to the world that we closed this particular project and this acquisition. So all of those things help with a reputation standpoint. All right, let's see. Any other questions coming in for your email? I don't see any coming in through there. Again, if I don't get to your question, it's not because I don't like you or anything. It's because we might not have the time, but I'm going to try to get to as many of these questions as I can. Let's see. I sent questions to the email you mentioned. Did you not get it? Maybe I actually might be in my spam box. Let me see. Yes, it did. Sorry about that, Christopher. Had an email that went to my spam box here. So I got to check my spam at the same time when these things are coming in. What you have built is extremely impressive, and having such a large company is all about systems. Earlier on in your career, before the hockey stick, what was the number one thing you did to help you start scaling your business? More so that just doing little onesie, twosie deals. I would say the biggest thing was that really allowed me to scale. And I've said this on other podcasts and other venues when I've been speaking in front of on stages and stuff. One of the things that I had to learn early on is that even though I feel like I can do everything better than everybody else, and I admit that, and I still believe that today, and it's a flaw that I have, but it's hard to get over that. And so I had to come to the realization that even though I can do everything better than everybody else, and again, mental block, I had to learn to delegate certain tasks. And what I had to tell myself is that if I could hire somebody that's a really good, solid person and pay them well and keep them for a long time and treat them well, and I could actually start to delegate some tasks that I was doing that was preventing me from growing and scaling. I could start to delegate some tasks to them. And even if they can only do it 85, 90%, I was not having to do it. And I can now continue to think about growing and scaling because I'm a visionary type person. I like to grow. I like to see expansion. And I also like to see things being done a certain way. And so being able to hire that team to be able to do those things and keep them accountable on those things is very important. There's actually two different types of leadership here. So there's on one side of the spectrum, there's leadership by micromanaging everything that your staff your team is doing, which your team usually does not like that. And then the other side of it is leading by what's called abdication. So you're basically just setting it and forgetting it, and never following up and never getting accountability to them. And there's got to be some sort of happy median in the middle where you come together and have this ability to give them some free rein to be able to make decisions and make mistakes. That's how they're going to learn, but also still have that accountability aspect and factor in there. I think that's also where having some regular, meetings with your team is very important. We have a weekly meeting with our team every single week with the passiveinvesting.com team. The other businesses that I have, I meet with them on a monthly basis. I meet with my corporate director team. And then I also meet with my other team at least probably once a month as well. And kind of on my other businesses too. And then they internally meet more than that. But I think the biggest thing is making sure everybody knows what everybody else is doing. And also for you as the business owner and the CEO, learning how to delegate your responsibilities so that you can continue to grow and scale. And it also allows you to be able to step away from the business whenever you're ready to step away and let your team be able to run it and handle it, so that you can go on vacation to London for 2 weeks, or go to Italy, or, just go to Hawaii, or, do the things that you really want to do with your time, and having that flexibility. A lot of times we think of financial freedom as being financially free and the ability of being able to have as much money as you need to do whatever. And that's really not financial freedom. To me, financial freedom is being able to do and have control, being able to do what you want to do and have the control over your time. Because the one thing that we can never get back is time. It's constantly going on. And that's the one commodity that is the most precious commodity that we have. And it is something we never get back. If I lose $100,000, I can make $100,000 back. But if I lose a week, I cannot get that week back. And so whatever you can do to be able to delegate and make more time for yourself, again, it goes back to your question, Christopher, what I feel has been the thing that has helped us be able to grow and be able to have that hockey stick in the business. Let's see. Another question coming in here. There we go. Soheil has a question about when discussing preferred return and they split. I understand when an asset is sold, how the preferred return and the split work. What I want to understand is, does the same formula work on the operating income? So yes, that is correct. That is actually correct. And so there's actually two ways to look at, Soheil, the preferred returns and the splits. And so the preferred return is that usually, 7 or 8% preferred return, depending on the project or the deal. And basically in the waterfall, or how the investors and the sponsorship team is paid, is that typically the first 7% of cash flows, as well as any capital event, is given to the investors first. And then anything over and above that is usually split. In our group, it's 70-30. Some people do, 80-20 or 50-50 or whatever the case may be. But there are some operators that also, once you go to a capital event, the preferred return doesn't go there anymore. It just goes away, and it's just a straight 70-30 split. So it depends on the operating agreement that you're set up with. So you have to make sure that you actually watch that very closely. All right. Let's see. One of the things I wanted to mention to you guys, I know some of you are trying to connect here, and I want you guys to continue to network and connect on our Facebook group. If for some reason we're not able to connect here, so I'm going to type in here a link to our Facebook group. You can go there. If you're not part of the Facebook group, it is a closed group, so you can go there, fill out the questions, and we will approve you guys so you guys can connect up. So if for some reason you guys can't connect here, Would love for you guys to join us on the Facebook group. We try to be as active as possible there as well, announcing various webinars and things like that too. So for those of you who are watching the recording, it is down in the description of the comments. You can click on that Facebook group to join it for us as well. All right, next question that's coming in from Sohail is, are the asset management fees per annum or on the total of the project term? So the asset management fees are typically paid out monthly, and they are based on the monthly income off the property, and it's the gross income. So if you collect $10,000 a month, that 2 or 3% or whatever it's going to be is going to be based off of the income off of the property. Very similar to the property management fees, which are based off the gross collections or the gross income as well. Now, there are some operators, again, that will kind of modify that and change it where it's based off of the overall asset size, or I've seen it sometimes on the overall portfolio or, equity raise side. So it really depends on the operator, but most common way to do it is to base that asset management fee off of the gross income off of the property. And one of the things that our group does is that we have obviously monthly distributions, monthly cash flow that's been given to our investors. We start that after we have a full month of operations into the project. So we're closing a deal this month, October. We're going to wait till I have a full month of November, and our first distribution to our investors is going to be in December. And so those distributions are done first, and then if there's leftover cash, then we take our asset management fees. So we want to make sure that we protect our investors first, because number one, we're investors in our projects first, and so we want to make sure we protect all of the investors that are in the projects. Next question is coming from Sohail as well. What's the difference between a waterfall and a split? So a waterfall is, if you kind of think of it as buckets, if you will. So that are kind of like, they would start at the top, and then they start at the top, and then they would go down. And so as you're filling in these buckets of water, that's where the waterfall kind of concept comes from. Once you fill up the money in that one bucket, once you fill that 7% preferred return, then that money is going to, once it's filled up, is going to overflow to the next bucket, which is going to be that 70-30 split. So there'll be two buckets there, right? You'll have a 70% and a 30%. And then the waterfall is the actual structure of how those splits are laid out. So a typical structure that we do with our projects is that we'll have typically a 7 or 8% preferred return, and that 7 or 8% preferred return, once that's paid, we'll have an equity split of 70% to the investors, 30% to the sponsorship team. Once that's been met up to our projected IRR, so and let's just say hypothetically we have a 15% IRR, when we get to that 15% IRR, and we've performed on the asset, we change the equity splits to 50-50. So 50% to the investors, 50% to the sponsorship team. And it just depends. A lot of times, you'll see some deals that'll have 4 or 5 different waterfall or split structures, or what they call hurdles within the waterfall structure, which has different splits. So I'm not sure if I answered that properly or confused you more, Sohail, but hopefully that shed a little bit of light on it for you as far as the differences between waterfalls, equity splits, and structures, as well as the preferred returns. All right, let's see here. Looks like I might have another question. And then I'm going to take one more question here. I think there might have been another question on the ones that I got from yesterday. So let me see here. All right. All right. All right, so I'm going to take this last question. I'll take 2 questions that are in the chat box here. Question is, do you put the stay clause in the LOI, no engagement with other buyers, if our LOI is accepted? So yes, so the LOIs are usually non-binding for the buyer, but they're binding for the seller. So what you would want to make sure you have in there is a clause that basically states that they cannot, while it's under LOI, they cannot shop it and continue to shop the deal with other buyers, and potentially you lose the deal because somebody else came in and overbid you. So you do want to make sure you have that in place. It's not always a guarantee that they're going to sign the LOI. Like in our situation with our deal, we really wanted them to sign the LOI, but for us, it kind of just forced us to want to move faster in getting the PSA signed. So it actually worked. So we got that PSA signed in a matter of about 4 business days, moving back and forth with their attorney and our attorney and things like that. So you definitely want to make sure you put it in the LOI, but it doesn't necessarily mean that they're going to accept that. Obviously, that's with any type of contract. And Christopher says, thank you for that answer. Follow-up question. Who was your first hire? The first hire in the apartment syndication space was my assistant. And my assistant's role is primarily from managing the investors, because we have 3 managing partners. One does acquisitions, one does the underwriting and financial analyzing. So we had those 2 pieces and pillars in place. And my role was primarily investor relations. But when we're trying to raise money for a project and we're trying to get the PPM signed and the money wired in and giving notifications to investors and putting the ACH distributions into the system so they're ready to go out, and managing the emails and the updates for every asset, because we do monthly updates on every single one of our assets, it can be a little bit of a pain and a little bit cumbersome, but I wanted to make sure I had somebody else helping me with that. And so my assistant was the first person that I hired. And so she was very, very crucial for us, and still has been, and has been a great benefit to us. She's still with us today. But one of the things that we do to try to vet our new hires is we have them take a specialized test, which it's a personality test, it's a cognitive test, and also a motivation test. And you can find some more information about that test by going to Wonderlic or Googling Wonderlic test, WONDERLIC. And they take that 1-score testing that allows us to kind of, instead of going through and interviewing, 20, 30 people, we can put some 20, 30 candidates through this testing program, and it helps us to be able to weed out some people that we might not want to waste our time with. And so I would definitely encourage you in trying to hire somebody, so you can try to hire the right person the first time, to have them take that test, because it will definitely help you. It's not the end all be all, but it definitely helps you gauge the type of person that you're wanting to be able to hire. Well, it is coming up on 3:45 Eastern Standard Time, and it has been fun. It has been great. You guys have been awesome in this and all these questions. Hopefully you guys found these questions helpful, or hopefully you found the answers helpful. And thank you so much for being very attentive. Make sure that you go and subscribe to our podcast right now. You can go to mfinpodcast.com, subscribe to it, listen to it. On that podcast, we only interview people that are closing real multifamily deals. And so if you've closed a deal in the last 12 months, shoot me over an email. I want you on the podcast as well, dan@passiveinvesting.com. And I also want you to subscribe to it, rate it, and review it. Take a screenshot of that review, send it to my email. And next week on the webinar, we're going to be doing a drawing for a free ticket to the next Multifamily Investor Nation Summit. And you can find more details about that summit at mfinsummit.com. Thank you guys so much, and hope you have a good rest of your week.